It is a time where investors try and navigate seeming headwinds, but an ability to keep on going for the growth of AI. How do you think this lands the China versus US at the moment, Janet?
Good morning, Caroline. Thanks for having me. I think in terms of the tech investment side, we will still be heavily preferring the US. I mean, the US is a hub of innovation, and I think the regulatory pressure on China would remain, and I think the trade tension primarily will hit China more than the US. So I think from an investment perspective, I think all these trade tensions obviously is not great from price or from global growth, trade, and the global market uncertainty point of view. But I think sticking with the US investment seems to be the right approach.
Exactly. I'm trying to pass all of this together, right? I think there's a growing confidence that inflationary pressures are easing off. But a big part of that is US fiscal policy, right? We're talking, or Janet Yellen talking about how China has some anti-competitive practices. But here in the United States, if you take the chip industry, this country is also pumping billions of dollars into supporting its growth. How does that impact you as an investor?
I think the clear evidence is that there's a lot of investment from a sovereign perspective into semiconductors, given it is such an important strategic sector. So I think the conclusion is that there will be lots of money going into it, lots of investment, a lot of big players will be involved. And I think primarily, the US companies are likely to be benefit from this initiative. And that's why we still have a positive stance on the general semiconductor value chain story, either from the equipment production or from the design, from the manufacturing, the foundries, along the whole supply chain. I think there's still going to be lots of investment going into it. I think valuations in these US companies are still quite reasonable, given that there is strong earnings growth. And I think we still have pretty good visibility into the 2025 earnings from the orders guidance, et cetera. So I think the investment thesis we have is that invest in US tech, particularly favoring in the semiconductor sector.
Janet, do we see a rate cut from the Fed this year, to your mind? And if so, when and in what increment?
Well, it is difficult to say. I think the bar for a rate cut is definitely higher now. We'll wait the CPI print on Wednesday, but I think the Fed, they have a leaning on the next move being a rate cut rather than a rate hike. So I think there's still some preference on eventually cutting. I think they're really itching on doing that, but they just need the data to allow that. So our view is that it's more likely to happen in the fourth quarter, but I think the Fed can really move, when the data allows. I think there's a lot of chatter about how the Fed may not be able to move because of the timing of the presidential election, but we think the Fed will focus on the data instead of trying to appear not to be political.
I want to go back to what you just mentioned about valuations looking pretty good at these levels, and many, Janet, have just been, holding their breath at the ARM 90 times future earnings valuation that we've seen, and ARM pops on the day. We're going to have a much deeper dive into the chip sector in a moment with our own Ian King. But Janet, from an investment landscape perspective, do you have to keep on building in the AI infrastructure play, or do we broaden out at this moment?
So I think to your point about the valuation of ARM, I can't really comment on the individual company, but obviously we know that within the sector, there are a lot of players, and there will be different ranges of valuations. So I'm talking about as a group, because of the strong earnings growth. I think some of the major players the valuations are reasonable, but you have to really look into individual case. I think in terms of the broadening of the theme, we already have seen that. There is more confirmation from mega cap tech companies that there is commercialization of AI that is gaining traction. We see that from Alphabet, Microsoft, Amazon, for example. So it has broadened out beyond just the chip sector. And I think there has been quite a significant pickup in the utility sector, right, because of the electricity demand. So I think that they will continue to broaden out, but I think it has already started.
I look at a valuation of one particular meme stock today, Janet. 3,000 times future earnings is where the current price of GameStop is. Are we going to see meme stock frenzy really hit us hard once again?
Well, it is hard to say. I think right now we are seeing a couple of individual stocks having that reaction. Not sure if that's going to last. It's a lot driven by social media. But I do think that what the current situation is an indication that the risk sentiment is back. I think the positive risk sentiment is not constrained anymore by these high interest rate environment, these current level of bond yields. I think the market rally or the market sentiment has already we already passed the stage when it's totally just driven by the Fed and bond yields, for example. So there's clearly plenty of cash still sitting around, waiting to be deployed.